The documents make clear that Fannie Mae and Freddie Mac knew what they were doing. Their own risk managers raised warning after warning about the dangers of investing heavily in the subprime and alternative mortgage market, but these warnings were ignored. In 2004, Freddie Mac's chief risk officer sent an email to CEO Richard Siren urging Freddie Mac to stop purchasing loans with no income or asset requirements as soon as practicable. The risk officer warned that mortgage lenders were targeting borrowers who would have trouble qualifying for a mortgage if their financial position were adequately disclosed, and that the, quote, potential for the perception and the reality of predatory lending with this product is great. But Mr. Siren did not accept the chief risk officer's recommendation. Instead, the company fired him. A year later, on November 10, 2005, a top Fannie Mae official warned, quote, our conclusion has consistently been that the layering of risk in many of these private label securities has not adequately been reflected in their pricing, end quote. On October 28, 2006, Fannie's chief risk officer sent an email to company CEO Daniel Mudd warning about a serious problem at the company. He wrote, quote, there is a pattern emerging of inadequate regard for the control process, end quote. In another email on July 16, 2007, the same risk officer wrote to Mr. Mudd again, this time complaining that the board of directors had been told falsely that, quote, we have the will and the money to change our culture and support taking more credit risk, end quote. The risk officer wrote, I have been saying that we are not even close to having proper control processes for credit, market, and operational risk. I got a 16% budget cut. Do I look stupid?